Trump's new tariffs are shaking global markets. But what does this mean for the stock market? And why is the rupee falling? Stay with us and we'll explain everything in this video. And make sure to watch till the end because we'll share how Indian investors and traders can deal with these tariffs.
A new round of executive orders signed by President Trump today, this time for tariffs on goods from Canada, Mexico, and China.
Under his administration, Donald Trump has used tariffs as a tool to address trade imbalances and protect US industries. His recent actions include reinstating a 25% tariff on steel imports and increasing tariffs on aluminum to 25%. On February 1, 2025, he signed executive orders imposing new tariffs on Canada, Mexico, and China, starting from February 4, 2025. These include 25% tariffs on imports from Canada and Mexico, 10% tariffs on imports from China, and 10% tariffs on Canadian energy resource exports. There are no exemptions, and even small shipments below $800 will now face tariffs. This decision may lead to other countries fighting back, making trading problems even worse. But how does this impact India?
Stock benchmarks have slumped after hitting record highs in September last year, with several key indices entering a technical correction level. That slowing growth and demand have weighed on company earnings and investor sentiment, as reflected in the market slide this year.
The Indian stock market has reacted negatively, experiencing a major sell-off and volatility. Let's look at the numbers. On Tuesday, the Sensex fell by 1,018 points, that is 1.32% to 76,293.60. The Nifty dropped 309 points, that is 1.32% to 23,071.80. Small cap and mid cap stocks faced even bigger losses. Investors are worried and many foreign investors are pulling their money out of Indian markets. But why? Trump's tariffs could hurt global trade, increase prices, and delay interest rate cuts in the US. Because of this, money is moving out of Indian stocks and into US dollar investments. Another major impact? The rupee is falling sharply. But why? Economic uncertainty. Trump's tariffs on big trading partners like China, Canada, and Mexico are causing worries in the market. Because of this, investors are moving their money to safer options like the US dollars. Foreign fund outflows. Foreign investors are selling Indian stocks and converting their rupees into dollars. Now, this increases the demand for dollars and makes the rupees even weaker. Stronger US dollars. Naturally, when the US dollar becomes stronger, the Indian rupee loses its market value. Higher import costs. India buys 87% of its crude oil in US dollars. A weaker rupee means India has to pay more for imports, which increases prices and pushes inflation further up. Trade deficit worries. Since imports become more expensive, India's trade deficit, that is the gap between imports and exports, gets bigger, putting even more pressure on the rupee. While the RBI has tried to control the rupee's fall since it's moved freely in the market, global factors will still affect its value. So, what's next for India? The focus is on how India is responding to Trump's tariff policies and what potential outcome investors should watch out for. Government strategy. The Indian government is avoiding a direct fight with the US over tariffs. Instead, India is thinking about reducing tariffs on 30+ items like luxury cars, solar panels, and chemicals to keep trade stable. Economic and trade adjustments. India might look for new trade partners or sign special trade deals to reduce the impact of US tariffs. The government may also bring in economic reforms to attract more foreign investments and keep the economy stable. Investment strategy and market outlook. Investors should watch market trends, affected industries, and global economic changes to make smarter decisions. Over time, India could grow its local industries by relying less on imports. Now let's talk about the most important thing. With all these market changes, what should you do as an investor or trader? Here are some key steps to stay ahead. Number 1, increase diversification. Spread your investments across different asset classes and regions to reduce risk from trade wars. Number 2, manage volatility. Markets will be more volatile, so have a strategy in place to handle ups and downs. Number 3, Take a long-term view. Avoid panic selling. Market dips due to tariff uncertainties are short-term hurdles, so focus on long-term growth. Number 4. Watch sector exposure. Some sectors like luxury cars, spirits and high-end goods are more vulnerable to tariffs. Keep an eye on these. Number 5. Evaluate company pricing power. Invest in companies that can maintain strong pricing even with rising tariffs. Number 6. Look for buying opportunities. When market drops due to tariff concerns, it might be a chance to buy good stocks at lower prices. Number 7. Stay informed. Follow the latest updates on trade negotiations and policy changes to make smart investment decisions. So what's the key takeaway? Stay informed, diversified, and focus on the long-term growth. Market volatility can be an opportunity if you plan wisely. Thanks for watching this video. We'll see you in the next one. And don't forget to hit the subscribe button and click the bell icon for more updates on stock market.
Investments in securities markets are subject to market risks. Read all the related documents carefully before investing.